I want to start with a question that I think is sitting in the mind of every person who owns gold right now. You bought gold. You watched the geopolitical chaos. You watched oil go from $72 to $120 at its peak. You watched Iran close the Strait of Hormuz. You watched bombs fall on Tehran. You watched central banks buy 900 tons annually for 3 consecutive years. You did everything the macro framework said to do, and your gold position is down again. Spot gold is trading at $4,661 as of this morning, April 24th, 2026, down more than 2% this week, down roughly 17% from its all-time high of $5,595 reached on January 29th. Oil is above $105 per barrel. The Strait of Hormuz is still largely closed despite a ceasefire extension. U.S.-Iran peace talks stalled this week when Iran refused to come to the table unless the U.S. lifted its naval blockade, and gold is falling. Morgan Stanley just cut its year-end gold target from $5,700 to $5,200, saying the recent weakness has changed the tone of gold. And the retail investor reading that headline is asking the same question they asked in March when gold fell 23% from its high, while bombs were falling. If gold doesn't go up during a war, when does it go up? That question has an answer, a precise, mechanical, historically documented answer, and I want to give it to you today, not as a prediction, but as a sequence. A sequence that has repeated after every major oil shock in the last 50 years without a single exception. Because once you understand why gold is falling right now, not the surface explanation, but the actual mechanism, you will understand exactly what always comes next. And you will understand why JP Morgan is maintaining its $6,300 year-end target, why Goldman Sachs is maintaining $5,400, why Bank of America and Wells Fargo are holding $6,000 to $6,100, and why not one of those institutions moved their structural targets when Morgan Stanley cut. They did not miss the Morgan Stanley note. They read it, they looked at the same price action, and they reached a different conclusion. I want to show you why. Subscribe now. Here is the mechanism. Write this down because this sequence is the only thing that explains why gold falls during a war and why what always comes next is the opposite of what the falling price implies. Step 1. A geopolitical shock produces an oil price spike. The U.S.-Iran war that began on February 28th drove Brent crude from approximately $72 per barrel to a peak of nearly $120, a move of more than 55% in roughly 6 weeks. One of the largest oil price surges in recorded history. Brent is currently at $105. The Strait of Hormuz, through which 20% of global daily oil supply flows, remains largely closed. Iran has demonstrated it can restrict and condition traffic through the strait even after a nominal ceasefire announcement. The Iranian parliament is actively discussing legislation that would require all vessels to pay tolls for passage. The oil shock is not temporary. Step 2. The oil spike drives inflation expectations higher. Not actual inflation immediately, but expectations. And expectations matter to financial markets as much as reality, because financial markets price the future, not the present. When oil rises from $72 to $105 and stays there, every economist, every Fed watcher, every inflation model on every trading desk in New York, London, and Tokyo begins revising its inflation forecast upward. The inflation that oil above $100 per barrel generates takes 3 to 6 months to fully manifest in core CPI and core PCE data. It is coming. The market knows it is coming. And the market prices it before it arrives. Step 3. Inflation expectations prevent the Federal Reserve from cutting rates. The Fed held rates at its most recent meeting. CME FedWatch shows the probability of a rate cut before late 2026 at virtually zero. A Reuters poll of 30 economists published this week projected the Fed will wait at least 6 months before cutting. The oil-driven inflation shock has taken the Fed's easing calendar and pushed it into the future. Every week Hormuz stays partially closed is another week of oil-driven inflation embedding into the system. Every week of embedded inflation is another week the Fed cannot cut. Step 4. If the Fed cannot cut, the 10-year Treasury yield stays elevated, currently at approximately 4.3%. That yield represents the return on the world's most liquid, most creditworthy, risk-free asset. When you can earn 4.3% annually on a U.S. government bond with no credit risk, no storage cost, no volatility beyond the normal fluctuation of rates, the opportunity cost of holding gold, which pays zero, rises significantly. The institutional investor running a $50 billion portfolio does the math. earn 4.3% on treasuries, or earn 0 on gold. At a large enough yield differential, some of that capital rotates. Step 5. Simultaneously, the dollar strengthens. The DXY is currently at 98.3 near its recent range highs. This happens because global investors buying dollar-denominated assets to gain exposure to 4.3% yields must first acquire dollars. That demand for dollars strengthens the dollar, and a stronger dollar mechanically suppresses the dollar price of gold because gold is priced in dollars globally. When a dollar buys more, it takes fewer dollars to buy an ounce of gold. The oil shock that should have been bullish for gold created the exact monetary conditions, higher yields, stronger dollar, persistent inflation expectations that suppress the paper price of gold in the short term. This is why gold is at $4,661 while bombs are still falling and tankers are still blocked. And this is the mechanism that has operated in every major oil shock since 1973. Not sometimes, every single time. Now, let me give you the historical record because this is not opinion and it is not comfort. It is documented price history that goes back 50 years, and every data point in it says the same thing about what always comes next. The year is 1973. OPEC announces an oil embargo. Crude goes from $3 to $12, a fourfold increase. Gold initially spikes on the fear, then pulls back. Financial journalists write that gold has failed to perform as a safe haven. Retail investors who bought the initial spike begin selling. And then, when the oil shock has fully embedded into the inflation data, when the Fed's policy response has been recognized as insufficient, the structural move begins. Gold rises 150% over the following 2 years. From the 1971 Nixon shock through the end of the inflationary period in 1980, gold rises 2,300%. Not from the moment of maximum fear, from the moment the structural constraint on monetary debasement became undeniable. The Iranian Revolution, 1979. Oil production collapses. Prices go to levels that seemed impossible 6 months before. Gold does very little immediately, then rises 89% over the following 12 months, then another 10% the year after. The Gulf War, 1990. Iraq invades Kuwait. Oil spikes. Gold pops roughly 10% in a few weeks, then pulls back. The investors who sold the pullback missed the multi-year move that followed as the monetary consequences of the oil shock embedded into the system. Post-September 2001, markets crash. Gold begins a decade-long bull run from $250 per ounce to $1,900, a 660% move over 10 years. Russia invades Ukraine 2022. Gold breaks through $2,000 for the first time, new all-time highs. Every major oil shock in the last 50 years followed by significant gold outperformance, not because of luck, because the mechanism I described, the one that temporarily suppresses gold during the shock, eventually reverses. And when it reverses against the structural backdrop that the shock has made more extreme, more urgent, and more mathematically inescapable. Higher debt, more monetary debasement pressure, more central bank buying, more fiscal constraint on the Fed's ability to fight the inflation it created. Now, I want to address Morgan Stanley's cut directly because it is the most serious recent argument that the current episode is different from the historical pattern, and it deserves a precise response rather than a dismissal. Morgan Stanley's commodities team cut its H2 2026 gold target from $5,700 to $5,200. They cited two specific arguments. First, a rare supply shock combined with rising real interest rates driven by delayed Fed rate cuts. Second, that this combination has changed the tone of gold, shifting it from a pure safe haven hedge driven by uncertainty toward a macroeconomic barometer that reflects liquidity conditions and bond yields. They concluded that the path forward for gold will be more data-driven and less sentiment-driven. Both observations are correct as descriptions of what is happening in the paper gold market right now. The paper price of gold is being suppressed by the mechanical relationship between oil, inflation, yields the dollar, and algorithmic trading systems that sell gold automatically when the DXY rises above 99 and the 10-year yield rises above 4%. These are the same forces I just described in the five-step mechanism. Morgan Stanley is accurately describing the short-term paper price dynamics, where the Morgan Stanley analysis and the J.P. Morgan, Goldman Sachs, and Bank of America analysis diverge is on a single question. Is the current suppression mechanism permanent or temporary? Morgan Stanley is saying the tone has changed. The other institutions are saying the mechanism operates within a structural framework that has not changed. And to understand which view is correct, you need to look not at the paper price, but at the structural data. Central bank gold purchases are averaging 585 tons per quarter in 2026, according to the latest data. That is double the pre-2022 historical average. 95% of central banks in the World Gold Council's most recent survey expected gold's share of global reserves to increase over the next 12 months. China continued adding to its gold reserves through March 2026. Malaysia and South Korea resumed reserve additions after extended pauses. The physical gold demand from sovereign institutions is not responding to the paper price decline by reducing purchases. It is absorbing the paper price decline as a buying opportunity. The structural demand floor has not moved because Morgan Stanley revised a paper price target. It moves when the strategic logic that drives central bank accumulation changes, and the strategic logic, the need for reserve assets that cannot be frozen by executive order, that cannot be devalued by a single government's monetary policy, that carry no counterparty risk, has not changed. It intensified in 2022 when Russian reserves were frozen, and it has not diminished since. Let me now give you the two indicators I am personally watching to identify exactly when the suppression mechanism reverses, because the timing of the reversal is what determines when the paper price and the structural price converge. Write down these two numbers. The first is the DXY, the US dollar index, currently at 98.3. The dollar is the primary mechanical suppressor of gold prices in the current configuration. When the dollar index falls below 97, the most powerful single headwind against gold prices diminishes. The dollar falls below 97 when the oil-driven emergency demand for dollars, the demand created by energy importing nations scrambling to acquire dollars to pay for oil above $100, begins to moderate. That moderation happens when one of two things occurs. Either the Strait of Hormuz reopens fully and oil falls back toward $85, reducing the emergency dollar bid from energy importers, or the Fed is forced to cut rates despite elevated inflation because the debt arithmetic of $39 trillion at 4.3% becomes fiscally catastrophic before the inflation risk it is trying to prevent. Either outcome weakens the dollar. Both outcomes are bullish for gold. The second indicator is the 10-year Treasury yield, currently at approximately 4.3%. When this falls below 3.5%, the opportunity cost argument against holding gold collapses. The yield falls below 3.5% when the Fed cuts rates. The Fed cuts rates when the combination of 0.7% GDP growth, rising private credit defaults, the $9.2 trillion refinancing wave, and the $1.03 trillion annual interest payment on the national debt makes maintaining restrictive monetary policy fiscally unsustainable. These are not speculative scenarios. They are the mathematical destination of the current fiscal trajectory. The debt load is the ceiling on how long the Fed can maintain rates that suppress gold. Watch the DXY, watch the 10-year yield, not the daily gold price, not the Morgan Stanley revision, not the Iran headlines. The DXY and the 10-year yield tell you when the suppression mechanism is exhausting itself. Everything else is noise. Here is what the institutional targets tell you about the gap between the paper price and the structural price. Gold is currently at $4,661. JP Morgan's year-end 2026 target, $6,300. Goldman Sachs, $5,400. Bank of America, $6,000 to $6,100. Wells Fargo, $6,000 to $6,100. Deutsche Bank, $6,000. The consensus average of all major institutional targets, excluding Morgan Stanley's revised $5,200, sits at approximately $6,000. The gap between where gold trades today and where the research departments of the most sophisticated capital allocators on Earth project it by year-end is not a rounding error. It is a $1,339 per ounce gap at the conservative end and a $1,639 gap at the JP Morgan target. And none of these institutions moved their structural targets when Morgan Stanley cut. JP Morgan, which employs more macroeconomists than most governments, looked at the same price action, the same Morgan Stanley note, the same Iran ceasefire headlines, and kept $6,300 unchanged. Goldman Sachs kept $5,400 unchanged. Bank of America kept $6,000 unchanged. The reason they held their targets is not stubbornness. It is the same reason a doctor who sees a patient's temperature spike during a flu does not revise their prognosis for full recovery. The short-term symptom does not change the structural diagnosis. The structural diagnosis for gold in 2026 is the same diagnosis it was in January when gold was at $55.95, $39 trillion in national debt, $1 trillion in annual interest payments, $9.2 trillion in debt to refinance this fiscal year, central banks buying at double the historical average, the petrodollar having expired without renewal in June 2024, the Warsh trap closing in May when the new Fed chair inherits a fiscal position from which no monetary policy response escapes without choosing which catastrophe to accept first. None of those structural conditions have changed because oil drove inflation higher and the paper price of gold fell 934 from its high. There are two types of investors reading the gold price today. The first type sees 4,660 wires, reads the Morgan Stanley revision, sees the stalled Iran peace talks, sees oil above $105, and concludes that the gold thesis has broken down. They are making the same calculation that retail investors made after every oil shock in the last 50 years during the mechanical suppression phase. They are reading the short-term paper price as a verdict on the structural case. They sold in March when gold fell to $4,250. Some of them are watching the partial recovery to $4,661 and considering re-entering. Some of them sold again this week when the weekly decline broke the 4-week winning streak. In every cycle I have watched over 40 years, this investor is the one who buys the emotional spike, sells the structural pullback, and then watches the structural move from the sidelines. The second type of investor is reading the same price and asking a different question, not why gold is falling. Why are JP Morgan, Goldman Sachs, Bank of America, and Wells Fargo holding targets of $5,400 to $6,300 when the paper price is at $4,661? The answer to that question is the mechanism I described. The structural price and the paper price are different things. They are separated right now by a gap that the suppression mechanism is creating and that the suppression mechanism will eventually close. The mechanism closes when the DXY falls below 97 or when the 10-year yield falls below 3.5%. Both of those moves are mathematically inevitable given the fiscal constraints I described. The question is only the timeline, and the investors who understand the timeline, who watch the DXY and the 10-year yield rather than the daily gold price and the Morgan Stanley revision, are the ones who will look back at $4,661 on April 24, 2026, the way that the investors who understood the 1973 oil shock looked back at gold's suppression phase in late 1973 and early 1974 not as a failed thesis, as the accumulation window that the mechanical suppression created inside a structural bull market that the oil shock made more extreme, not less. Watch the DXY, watch the 10-year yield, ignore the Morgan Stanley revision and the daily Iran headlines. The suppression mechanism is running. It has always run during oil shocks. And in 50 years of oil shocks, it has never run indefinitely. Most investors will not understand what is happening until the mechanism reverses and the price confirms what the structural data has been saying all along. Now you do. Now let me address the specific question that I think is the most important one for anyone who is currently sitting on a gold position that is down from the January high. The question is not whether to hold. The question is whether the thesis that drove gold to $5,595 in January is the same thesis that applies at $4,661 in April. And the answer requires being honest about what has changed and what has not. What has changed is the paper price. Gold is 17% below its all-time high. The 6-week sell-off from January to March was the worst monthly performance since 2008. Morgan Stanley has revised its target. ETF outflows in March totaled 90 tons after inflows of 150 tons in January and February. Leveraged retail positions that were built during the bull run of 2025 have been partially liquidated. These are real changes in the paper market. What has not changed is every structural driver of the thesis. The national debt is $39 trillion. It was $39 trillion when gold was at $5,595. The annual interest payment is $1.03 trillion. It was $1.03 trillion in January. The $9.2 trillion refinancing wave is running at the same pace. The petrodollar agreement has not been renewed. France completed its gold withdrawal from the Federal Reserve Bank of New York. Germany's 1,236 tons are still in New York, and the political pressure to move them is growing, not diminishing. Central banks are buying at 585 tons per quarter in 2026. The BRICS unit, a gold-anchored digital settlement currency, launched its pilot program in October 2025 and is in active use. China continues to add to its gold reserves. The structural conditions that drove gold from more than 800 to 5,595 between 2022 and January 2026 are not only intact, they have been made more extreme by the oil shock that the Iran war created. The oil shock added an inflation layer on top of a debt layer that was already the largest in peacetime history. It did not end the thesis. It compressed the timeline of the fiscal reckoning that the thesis is built on. The paper price is at 4,761 R. The structural case is more intact today than it was at 5,595. Those two facts being simultaneously true is what creates the gap between the current paper price and the institutional targets of $5,400 to $6,300, and that gap is what the two indicators I described will close when the suppression mechanism exhausts itself. Watch the DXY. When it falls below 97, the primary mechanical headwind reverses. Watch the 10-year yield. When it falls below 3.5%, the opportunity cost argument collapses and the institutional rotation back into gold accelerates. Those two numbers tell you everything you need to know about the timing of what always comes next. The war is still ongoing. The Hormuz is still partially closed. The debt is larger. The central banks are still buying. The structural case has not changed. The paper price has. And in 50 years of watching oil shocks suppress and then release the structural price of gold, I have never seen the structural case fail to eventually assert itself. Most investors will sell at 4,661 Oz and buy back at $5,500, confused about why they missed the move. Now you understand the mechanism. What you do with that understanding is your decision. One final thought on timing, because timing is what separates the investor who captures the structural move from the one who watches it from the sidelines. The 4-week winning streak that ended this week tells you something important. It tells you that the structural buyers, the central banks, the institutional allocators who understand the framework I described were accumulating during the March lows between 4,250 and 4,189s. They drove the 4-week recovery. The current weekly decline, driven by stalled Iran peace talks and oil above $105 reigniting the same inflation yield dollar suppression sequence, is not a new development in the structural thesis. It is the same mechanical sequence running again at a lower starting price. The suppression mechanism does not distinguish between $5,019 and $4,660. It operates the same way at any price level, and the reversal, when it comes, operates the same way at any price level. The DXY below 97 and the 10-year below 3.5% do not care whether gold starts from 5,595 or 4,661. They release the same structural forces against the backdrop of the same structural conditions, producing the same directional outcome that JP Morgan, Goldman Sachs, Bank of America, and Wells Fargo have calculated and published. The paper price is $4,661. The structural price is $5,400 to $6,300. The mechanism that separates them is running. It has always run during oil shocks. It has never run forever.